We have a busy week coming up so far as data on the UK economy is concerned, with unemployment and wage growth due on Tuesday the 19th, inflation figures on the 20th, and then the latest GfK UK Consumer Sentiment Survey on Friday the 22nd. However, even they may be overshadowed by two central bank policy announcements, as both the Bank of Japan and the European Central Bank are slated to make their latest policy pronouncements on interest rates and quantitative easing on Thursday the 21st of July. Remember, the Bank of Japan has held its interest rate at minus 0.1% since February 2016. Meanwhile, its balance sheet has continued to swell as the BOJ has kept running a qualitative and quantitative easing program, QQE, that's designed to cap the yield on the 10-year Japanese government bond at 0.25%. At this latest meeting, the Bank of Japan is expected to do broadly nothing and stay on its current path. Meanwhile, the ECB has held its headline refinancing rate at zero since March 2016. Its last rate rise came in July 2011. Meanwhile, the ECB's balance sheet has swollen to a record high €8.8 trillion thanks to its quantitative easing or QE program, and that means the balance sheet is some 90% bigger than it was just before the pandemic. The ECB, however, is expected to act, and it's expected to raise rates and embark upon quantitative tightening. But President Christine Lagarde is already looking to follow up an alphabet soup of prior policy initiatives such as ZERP, QE, LTRO and TLTRO with another plan, this time to try and calm southern European bond markets in particular, and again do battle with the European dilemma of how to set one interest rate for so many countries whose economies have different needs and challenges and operate at different speeds. Even Germany looks to be slowing down right now, judging by how it showed its first trade deficit in 31 years, thanks to slowing exports and how oil and gas have increased its import costs. On the corporate front, the quarterly reporting season will be hitting its stride in the USA, and the number of trading updates here in the UK will also be on the rise. Names which may be worthy of note and further research include the following, although some of these dates could yet be subject to change. It looks to be a particularly busy week for miners, by the way. We got BHP and Kia on Tuesday the 19th, Antofagasta, Royal Mail, Abcam, Premier Foods and Centamin on the 20th, Anglo-American, SSE, Howden Joinery, Frasers, Dunelm, Kinetic, Britvic and MoneySupermarket.com on the 21st, before non-life insurer Beazley rounds out the week on Friday the 22nd of July. However, the company which could just cause the biggest fuss in the week ahead is Ocado. The online grocer and self-style delivery software and technology play is slated to release its first half results on Thursday the 21st of July. Now, Ocado shares are down by some 60% over the past year, and they're down by 3/4 from their all-time high of early 2021, and there are two or three possible reasons for this. First, rising interest rates mean that investors have moved away from perceived pandemic winners and long-term secular growth plays such as Ocado. Second, the firm is not expected to make a profit till 2025 at the earliest, as the elusive move into the black keeps moving back, and that seems to have cost the company a few supporters. And third, the firm continues to tap investors for cash. It's just raised £578 million through a share placing. That comes after a £330 million equity raising in 2018 and £1 billion offer of new shares and convertible debt in 2020 to fund the continuing development of the retail operation, which it now owns 50-50 with Marks & Spencer's and also the software technology platform. Given the lack of profits, investors could be forgiven for thinking that Ocado is becoming even more of a jam tomorrow story. Anyway, when it comes to these figures, analysts will home in on three key sets of numbers in the context of May's trading update, when Ocado was frankly pretty cautious. The firm flagged a 4 to 5% shrinkage in the grocery market overall, a bigger drop in online sales across the whole market, and also margin pressure from higher utility and energy and fuel bills, and even the cost of dry ice. So the first figure that analysts will look to is sales growth from retail, UK solutions and international solutions, the three main operating segments. Retail is the 50-50 delivery business with M&S, and Q1 sales fell by 5.7% year on year, while Ocado has also already flagged an 8% drop for Q2. This reflects inflation, the high cost of living and some volume retrenchment even at Ocado's relatively well-heeled customer base. UK and international solutions generate fees, from retail partners who use the Ocado Smart Platform or OSP for their own online deliveries. And that includes companies such as Morrison's in the UK, Sobeys in Canada, Kroger in the US, and Casino in France. For the year as a whole, analysts are looking for 9% revenue growth from the entire company to £2.7 billion for the year to November. Secondly, analysts will dig deeper into the retail business, looking at order run rates and basket size. At the first quarter stage, the order run rate was some 367,500 a week on average, with a basket size of £124. Basket size has begun to fall and normalise, but that £124 figure is still higher than it was pre-pandemic when the run rate was around 110. Again, inflation that will have something to do with that. Thirdly, attention will then switch to profit, or at least the lack of it. Ocado likes to refer to earnings before interest, tax, depreciation, and amortisation, or EBITDA, where the analyst consensus is for a profit of £22 million for the whole year to November, against £61 million last year. But that excludes a lot of costs, and on a pre-tax basis, analysts are looking for a loss of £352 million against a £177 million deficit a year ago. In the first half of last year, by the way, as a benchmark, the pre-tax loss was £24 million. More strategically, shareholders and analysts will then look for comments on the retail joint venture with M&S, the rollout of micro-sites to support Ocado Zoom, the planned one-hour delivery service in the UK, rollouts of the Ocado Smart Platform, where 7 of the 10 partners are now live, including overseas, and also the plans to add 9 customer fulfillment centres, or CFCs, this year, to take the total to 22 overall. I hope that you and your families are in good health and good spirits. Thank you for listening and watching, and I look forward to chatting with you again next week.